Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. I'm pleased to have Adam Katz with me today. Adam is the co-founder and CIO at Irenic Capital Management, which is a New York-based hedge fund. Adam spent about a decade at Elliott Management prior to Irenic. Adam, I'm so glad you can join us today.
Thanks for having me.
Let's go back to the beginning. What would you say initially drew you to the world of investing?
I grew up during the dot-com bubble, right? So during the 90s, and I'm not sure if you can call that investing necessarily, right? So, but whatever was going on in the 90s. But the idea of deploying capital, and having that capital work for you and produce a return, that was kind of in the ether or sort of in the ecosystem, in the 90s. So that was in and of itself kind of interesting to me, and sort of just being around that and sort of seeing that. So that was the first part, sort of going way back to sort of the beginning. And then there's a really wonderful book. It's an old book now, actually. A guy named Robert Hagstrom wrote a book called Investing. I think it's something like Investing as the Last Liberal Art. I may not have gotten that exactly correct, but Investing as the Last Liberal Art. And what Hagstrom wrote about is this idea that to develop an investment thesis requires bringing insights from across many disciplines and sort of stitching them together. So maybe it's psychology, it's economics, it's biology or engineering or all of the above, and stitching them together to develop a view of reality. And if you think about what investing is, it's sort of like assessing, like, what does the world think about? How is the world assessing the likely, future states of the world, right? How do market participants assess the future states of the world? And do I have a different view of those, of the likelihood of those various future states of the world? And then I'm, putting that view into practice and sort of investing around that view, and then ultimately the market will determine and events will determine if you're correct or not. And I've always loved reading. I've always a wide range: history, biography, current events, anything nonfiction across a wide range of disciplines. And so the idea of developing a view of the world, thinking about how my view related to the views of other market participants, of other people, being able to say, hey, I think I'm right about this, and then sort of test that proposition. And that test is also the important part. One of the things that was always appealing to me about investing is investing outcomes are objective. There's no teacher at the end of it where you submit a paper and it's like, okay, this is an A work or this is a B work. There's no office politics. There's no there's no tenure track committee like in academia, and so you got to navigate, the university politics and all of that. It's just simply the outcome is the outcome, and it's objective and it's real, and so that was always very appealing to me.
It's interesting what you just described. It sounds to me, it sounds very intuitive. To you, it sounds very intuitive. But there's an aspect of it that, just in my experience, is quite different from the way a lot of people think about investing. So what people think about is, what do I think the future holds? And I want to invest in those things that I think will benefit from that future, the future state. And what a lot of people miss is what does the market think, and how are my views different from the market? And that is a huge difference. And it's in some ways, it's very counterintuitive.
It's sort of that idea, that concept that you have to have a different, or, I think that a lot of investing goes around the idea of a variant perception. Having a view that's different from other market participants, that's always made intuitive sense to me. I'm not entirely sure exactly why. But famously, Charlie Munger talks about investing as kind of like a parimutuel, right? Where the odds are in part sort of dictating and moving around, based upon how people are betting. That has always made sense to me. Has always made intuitive sense to me. It's also, I think, informed. I mean, and by the way, that I'm sure we'll probably get to this later in the conversation. But if you think about the nature of what we do and how we invest, I mean, the idea that having a real understanding of where we're different, or where we're adding value, or where we're doing something different than other market participants is critical to how we approach investing in every aspect of what we do.
Yeah, because, and we'll get into this obviously, but if you have some control over future state, and that is insight that others in the market doesn't currently reflect, that is clearly an edge.
The genius of market systems is that in the absence of having an edge or having something different, right? there should be no excess returns. Right. And so I think that is our basic sort of intellectual construct on how sort of, markets, whether that's securities markets or markets broadly, right? Markets in which corporations compete with each other, right? How does capitalism work? Capitalism is designed to arb away excess returns in the absence of some, differentiated insight or edge.
Well said. So still in the beginning, before you got into investing, you decided to pursue a JD MBA. How has that influenced your career path?
I don't think I would have gotten my start at Elliott absent doing a JD MBA. And that's not I had a very unusual background before going to Elliott. I'd actually run an e-commerce business before doing the JD MBA, and actually did it a little bit for my first 2 years when I was in law school and in a business school. So I didn't have a traditional finance background of a couple of years in banking, a couple of years in private equity, and then to Elliott. So I don't think I would have had the opportunity at Elliott absent going to do the JD MBA program. And obviously that was a formative experience for me and a wonderful experience. So that's, I think, the first part of doing the JD MBA and how it shaped me. That's one. I think two, I spent a lot of time, especially in the back half of it's a 4-year program that I did, especially the back half of the back 2 years of that program, really focused on corporate governance, on mergers and acquisitions law, on bankruptcy law, and really having a deep understanding of how all of that works. And that's gone on to inform what we do today at Irenic, where we're spending a lot of time in equity activism. We do some opportunistic corporate credit. We're doing things that tend to have an element that touches on the sort of legal rights afforded to either minority shareholders, and every shareholder in a public company, or not every, but the vast majority of shareholders in public companies are minority shareholders. Right? If you own 100 shares of Google, you're a minority shareholder. What are the rights afforded to you as a minority shareholder? What can you do? What you can't do? How can you, how are you able to hold the management team and board to account? All those kind of things are things that I was thinking about from law school, and also then obviously in the case of credit, like those are obviously credits are basically credit securities are essentially dictated by contract, right? Your rights and obligations as a creditor are defined by contract. So those are, I would say, those are very practical. I'd say the third aspect of it, and I think actually, and Elliott thinks this way too. And my former ultimate boss, Paul Singer, was a practicing lawyer before he started Elliott. And I think what permeates that organization is thinking very, very deeply about what. Just reading the documents, reading, if you own a bond, read that indenture. If you own, a part of term loan, read that credit agreement, going through and just reading the documents, reading them closely, reading them in detail, thinking about all the different ways in which a motivated counterparty could sort of navigate around those documents to secure economic advantages at your expense, being very, very thoughtful about all those things. I think a lot of that started at law school and then was obviously enhanced by my time at Elliott. As I think back on it, over time, the law school aspect or the law school part of the JD MBA, the JD part of the JD MBA has tended to predominate in my thinking.
I'm going to share my personal experience because I also went to law school, and I'm curious if you agree or disagree with this perspective. So I studied economics and then I went to law school, and I think my mind works in black and white, and I saw the world in black and white before law school. And when you go to law school, they train you in the shades of gray. So, you ask an attorney a question, the answer almost always starts with "it depends," because they're operating within that shades of gray. And what I found and I didn't know this in advance, but I've learned since, is that investing has a lot of black and white and a ton of shades of gray. So having that balanced thinking has actually been very beneficial.
Couldn't agree more. I mean, I think the other thing that law school does, it forces you to recognize that markets, right, are a product of legal structures and legal norms that have been established that enable people to sort of compete and trade and participate in free exchange, right? And the legal rules and norms will shape how exactly everybody operates in those. That's one. Two, if you say to me, you own, I'm not making this up, by the way, but you own 100 shares of Apple and I own 100 shares of Google. I think most people, and certainly I would think prior to law school, that's basically the same thing. Where the residual, you own you're the residual claimant on cash flows, right? That's what equity is. You're the residual claimant on cash flows of the company. After creditors and tax and all that has been paid. But in fact, actually, Apple and Google, 100 shares of Apple and 100 shares of Google may be very different things. I'm again making this up. Apple might be domiciled in Delaware, and Google might be domiciled in California. And again, making this up. Delaware, directors generally owe fiduciary duties to shareholders, and Google may be in a state that's an expanded constituency state where the directors owe duties to a broad set of quote unquote stakeholders, right? So it could be shareholders, it could be employees, it could be communities in which it operates. So and then if you're an Apple, just to expand this point, if you're an Apple shareholder, you might have the ability to call a special meeting if you own 15% of the company, or you might be able to act by written consent in terms of removing directors or nominating director, things along those lines. You may not have those same rights at Google. So understanding and thinking deeply about what it means to actually say I own 100 shares of something, or I'm a bondholder, and so really, I think law school helped think about that.
Yeah, that makes sense. So you spent about 8 years at Elliott. What would you say are the most valuable lessons you took away from that experience?
I'll maybe break this up, and maybe the first part of this might sound a little bit. I don't want this to sound cliche or trite or anything like those. There's and these are. I think they're actually extremely important investing lessons, but they're not obvious investing lessons, I would say. And the first thing is, and I have tremendous admiration for Paul Singer and for John Pollack and for the entire team at Elliott. And my boss from the majority of the time was there, Dave Miller. I mean, it's an extraordinary group of people. It's a wonderful institution. And I think one of the things that Paul and John and everybody at Elliott really does well is says, I don't know. Sits in a meeting, just says, I don't know. Or, wait, slow down, explain that to me again. Or, I don't get it. Explain that to me like I'm a 5-year-old. Okay. And there's a real willingness. There's no fear about that. Hey, I'm going to look stupid if I ask this question. It's just always ask the stupid question, and I think the firm, and that starts at the top with Paul and with John, and that idea of being willing to look silly just to make sure you really understood something deeply. That ethos permeates the firm, and I think that's a wonderful thing, and I think that helps avoid a lot of mistakes. So that's the first thing. The second thing is, I co-founded Irenic alongside my partner, Andy Dodge. And Andy and I have known each other for 20 plus years. We lived together in college for 3 years. But watching Paul and John as partners and watching the way in which they respected each other, the way they treated each other, in which the way they hashed out disagreements. I mean, that was a real lesson in how to do a partnership right. Because I think one of the ways, if you look at how to firms like ours ultimately struggle or not work or blow up. I mean, Andy and I thought a lot about this when we started our firm, is partnerships is having two people start these things and have a falling out and not get along. And so we spend a lot of time thinking about how we work together, what our division of labor is, how we treat each other, and just seeing that example from Paul and John was wonderful. So I say those two things don't seem like they're not like this is how you hedge or this is how you do activism or this is how you read a credit agreement, but those are extremely useful lessons. I think that those are the first two things. I think in the department, I mean, there's so much in terms of just the tactical aspects of, say, doing equity activism, engaging in process-driven credit, go through like all those different tactics. But I think the most important thing, and this goes back to even the original discussion we had a few minutes ago about how to think about markets, is there's a real intellectual humility to Elliott and to that firm. And it is, the firm doesn't think it can necessarily, at least this is my view of the firm. I shouldn't speak for the firm. This is my view of my assessment. The firm doesn't necessarily think it could see the future better than the next person. What it does is it actually says, hey, we're not smart enough necessarily, or our hit rate on seeing the future better than the next person may not be sufficient to drive compelling risk-adjusted returns. But we can work harder. We can drive change. We can make things happen through our own, I think, Paul would use the phrase, quote unquote, manual effort. And I think that idea of making things happen, of being a force of getting paid for your work, I think was a sort of I took away from that firm what we're trying to do at Irenic.
Yeah, in other words, being honest about the factors within your control and those beyond your control, and those that are not predictable.
Yeah, that was a shorter, better way of putting it than I did. So yeah, I'll take that.
But Elliott also has a very strong reputation, I guess it's related to this, of being highly risk conscious. How did that perspective shape your approach to risk management? And how do you generally think about risk?
if you're humble about your ability to predict the future, right? You're not, let's make this concrete. If you're saying, hey, I want to invest in a company that is exposed to the aerospace cycle, what you might say is, okay, hey, I'm not sure I can predict the aerospace cycle better than the next guy, but I can do things at this company, improve its operating margins, work with the company to improve capital allocation, enhance corporate governance in various ways. Those are the things I can change. What I can't do is either predict or affect the aerospace cycle. So what I'm going to do is sort of hedge out the risk associated with the part that I can't necessarily predict better than the next person or affect. And so I think that's at the core of I would say the let's call it the position level hedging. That's certainly that we do, and I think that we do at Irenic, and certainly that my assessment that Elliott does. I think there's a second layer, which is just spending a fair amount of time thinking about the kind of sort of Rumsfeldian known unknowns and the wondering and trying to bring content to the unknown unknowns, and just finding ways of trying to mitigate those various scenarios in the way you construct the portfolio and the way you put on certain sort of tail risk type hedging positions.
My expectation and my experience is the unknown unknowns are probably the most dangerous.
Agree with that. Yeah, I absolutely agree.
So Elliott, you mentioned this just now, hedges out as much of the market risk as possible, largely because it's kind of beyond your control. And if you have a lot of control in other areas that can add value, then it makes sense that conceptually you'd want to hedge out as much as that you can't control. But that also can be costly because markets tend to rise over time. So how do you think about that in terms of the net cost over time?
Markets do tend to rise over time. I think we've generally, though, we've been in a reasonably benign, let's call it, even 50 to 60 year period of world history, in some ways. So you can sort of say, okay, well, there's been a lot of negative events, but they generally sort of it's been a tropism toward the positive, at least for sort of called Western securities markets. Open question if that's true over the next 50 to 60 or 70 years. So there's a real unknown in that sense, and I think it's worth considering that. That's the first thing. I think the second thing is if you look at great investment track records, and I think about, Andy and I, when we started this firm, our ambition is to build this firm over the next 30, 40, 50 years. And if you look at great investment track records, and I think almost in any way, to even call an investment track record a great investment track record, it has to be a track record that has extended has gone on for a long period of time through multiple market cycles. I think then you could say you have a great investment track record. Even 1, 2, 3, 4, 5. That may not even be enough to even say I think that you have a great investment track record. It's got to be longer than that. And I think if you look at great investment track records, those track records tend to be characterized, or there's evidence that the investor has had liquidity when other people don't, and has been able to take advantage of large dislocations in markets. And so I'm thinking about, and there are various ways of having liquidity when other people don't, right? So if you look at, say, Baupost, for example, there's a wonderful piece, I think it's probably a decade plus old, by a partner. I think there's like Brian Spector, I think was the partner at Baupost, who wrote this piece online. And Baupost runs generally with a very large cash balance at Baupost. And the basic idea, and people said, well, Baupost did these great returns despite running with a large cash balance. And this guy's point was, no. What you have to realize is the cash is sort of an option. And the performance wasn't despite the cash balance. It was because we had this cash when disaster struck, when liquidity was scarce, and they were able to deploy that cash at extremely attractive rates of return in those moments. So that's that's the Baupost model: run with a lot of cash and have that liquidity when you. And I'm obviously oversimplifying some of the stuff, but have that liquidity when others don't. That's one model. You obviously have something like a Berkshire Hathaway, which has operating businesses that generate a substantial amount of free cash flow every year that send that cash flow back to Omaha to then be allocated. It's got generated a substantial amount of insurance float. It's just generated on an ongoing basis that then Berkshire has the ability to invest. That's another model. And I think if you look at the model from Elliott, it's that you have hedges that tend to increase in value in large market dislocations that can then be monetized and allow you to be aggressive in large market drawdowns. I think those are, I would say, three different models. I think we generally tend to be, obviously we don't own large insurance subsidiaries or have operating companies that are sending us cash. We're probably more in the sort of Elliott Baupost camp of how to think about the world. And those are maybe aspirational. We aspire to be mentioned in that conversation, but that's how we think about the world. I'd say, in addition, I think this is important, and I think I've heard Paul talk about this. There's a psychological insight that I think is real, which is if you're experiencing a very large drawdown, if you're losing a bunch of money in periods of market stress, it's very difficult psychologically to be aggressive in those moments.
Yeah, because your natural inclination is to be defensive as opposed to playing offense.
Exactly. And if you are hedged, and if you put those hedges on prior to this large market drawdown, you're then able psychologically to play offense. You've mitigated some losses. You probably are still losing money, but not as much as everybody else, not as much as broader markets. And then you could monetize some of those hedges and play offense. So I think that psychological insight is important into why we're hedged.
And related to that, I suppose you could also play offense more aggressively during good times when you know you have a backstop.
Yeah, I think that's absolutely right, and that's a great point. And there's an important. So that's true broadly, and then there's a specific. But when you think about it at the position level, it's a really good point. I should have mentioned this is it being able to be hedged and being willing to be hedged, and widens the aperture, let's call it, of positions that you can put on. Right. So let's imagine, I'm again making this up, but let's imagine that you find that there's a really good opportunity in a business that sells into the automotive end market, right? And you may say, I don't know about the automotive cycle. I don't know if we're going to do 15 million SAR or 16 million SAR or 18 million SAR next year, and how am I going to figure that out, right? Well, if you hedge and you say I can be long, what I can do is be long this one company in the automotive industry that I think has a lot of different value that I can unlock through my engagement, okay, and I could hedge out the automotive cycle risk. Then you could actually put the position on. Then that's an actionable opportunity. If you're not hedging, you may say, the cycle is just, I can't figure this out. It's too hard. So the willingness to be hedged at the position level, to hedge out the industry and end market risk with which you're uncomfortable, actually enhances your ability to put positions on the page, even in good times or bad times.
Right. It basically broadens your universe because now what you're investing in isn't the market exposure plus whatever value you feel like you can extract. You're basically hedging out the market risk and you're limited to the value that you can focus on.
That's exactly right.
So you made a big decision about 3 years ago to leave Elliott and co-found Irenic. Would you talk us through that?
I would say 4 different things to think about. First is, I think, and this is by no means, I don't think I'm saying that the school is by no means a knock on my old shop. I think as that firm grew larger, there were a set of opportunities, I think, in smaller companies that I thought I'd be able to access with a smaller firm, with a smaller balance sheet that were just not practical to necessarily access at a much larger organization. I thought those opportunities in smaller companies were compelling, were interesting, were highly asymmetric in terms of the up-down risk reward in those situations. That's one. 2, my partner, Andy Dodge, who, again, I've known for a long time, he was at a firm that was mostly focused on those small and mid-cap companies and we would talk all the time, and he'd call me or I'd call him, and I'd say to him, what are you looking at? What stocks are you buying? What credit is interesting to you? And I found him increasingly talking to me about small and mid-cap companies that were really interesting and really compelling. And what he was great at, and Andy's strength is really, and this is not false modesty on my part, Andy's a better bottoms-up fundamental investor than I am. And he's, in my personal opinion, he's the best bottoms-up fundamental investor I know. And he's great at uncovering value and finding that value. And I think my strength is maybe unlocking the value that he finds. And so the idea was, really, can we put those 2 things together? His ability to uncover value, my ability to unlock value, and do something really compelling in the small mid-cap space. And then I think the third point is when I think about Elliott, I guess I had 4 points, but third point is when I think about Elliott, I think they're the best in the world at process-driven investing. And I thought if we could just take kind of that playbook or set of tactics that Elliott had honed over the years, and I learned from that playbook, and bring that down market, we could do something exceptional. I thought there was just a white space in that part of the market. And then the fourth thing is, and going back to even the very start of this conversation, I think you have to. Investing is this curious mix of being willing to say I can do something, I can make something happen, and in a situation, and also being extremely humble about your willingness or ability to sort of see the future or be smarter than other market participants. And certainly, I think Andy and I both in forming Irenic, We want to see kind of how good we were and how good we are. And I think that's a real part of this. I mean, when you're in a larger organization, to what extent is your success, or what extent are your successes or your failures a product of your own efforts, your own what you've done versus the larger organization? So we want to see for ourselves.
So you've touched on this a little bit, but could you share your vision for Irenic and what sets it apart in the hedge fund landscape compared to competitors?
Yeah, so break that part up. I mean, the first part I think is relatively straightforward. Right? The first part is we want to be the world's best process-driven investor in investing in generally public securities, so across the capital structure, equity and credit, in companies that are generally less than $15 billion in enterprise value. That's what we want to do. Full stop. Second part about what sets us apart is, I think there's a whole. David Einhorn, who's obviously a brilliant investor, has written in some of his letters lately that he thinks the market is broken. That the changing, for a variety of reasons, he points to, for example, that the shift from actively managed mutual funds to passive ETFs have left a number of securities, traditional value investor type securities, orphaned, small mid-cap companies, generally orphaned in public markets. And I'm oversimplifying here, but in the past, he would go and find this undervalued company, and he'd buy stock in the undervalued company, and he'd kind of sit around and just wait for that undercovered company to be discovered. He'd wait for mutual funds to come along and say, oh, this is a really interesting business with increasing earnings power, with compelling moat, whatever it may be, and he'd wait for those mutual funds to go and start buying it. And now, because of passive flows, because of ETFs, whatever it may be, that process of discovery does not happen in the same way. And I think Cliff Asness, from a more quantitative perspective, maybe top down looking at different trends, has also sort of written some stuff lately about the challenges in markets and the ways in which markets might not be as efficient as when he started his career. And I think what I think maybe sets us apart is we just decided we're going to make stuff happen. And the universe of firms that actually make stuff happen, as opposed to, say, just picking stocks, I think is reasonably small. And I think that's what sets us apart. One, the willingness to make stuff happen. Two, both the knowledge and ability to operate across the capital structure, I think are probably our defining characteristics.
So you just brought this up, that most investors are passive. They buy and they wait. So at a high level, would you talk about how you add value to the companies in which you invest?
How can a company be improved? Is maybe one question, right? I mean, if you think about, there are probably 4 or 5 different categories. One category is you can improve the operational performance of the business, right? The operating margins of the business might be lower than it should be based upon benchmarking to peers that operate in the same industry, right? So you might be earning 15% EBIT margins as opposed to 20% or 25% that your peers are earning. And maybe that's because you price your product incorrectly. And maybe that's because you have too many facilities and you got to consolidate facilities. Maybe that's because you have a bloated workforce and you need to cut costs, whatever it may be. So there's improving the operating performance of the business. And what we do in our investments is we bring in, almost like private equity does, we bring in an operating partner, somebody from industry who helps us diligence the investment, diligence the business, and actually helps us put together a performance improvement plan for the company in which we're invested in. And so that person will help us figure out, okay, can we actually improve those operating margins? If we're going to improve those operating margins, how are we going to do it? Right. So those are, that's one operational improvement's one area. Second area might be capital allocation. You might have a business that's operated really well day to day, but they don't allocate capital all that intelligently. So they take the free cash flow of the business and then they spend it on the pre-capex, let's call it pre-R&D free cash flow of the business, and then they spend it on unnecessary capital expenditures. They spend it on wasteful R&D. They go out and do poorly considered, poorly thought through M&A, value destructive M&A. It's very common. There are a variety of different ways in which capital allocation can potentially be improved in a company. That's a second area. A third area can be just corporate governance. Just this is a company where the board doesn't have the right skill set to actually steer the company for the long run. There could be ways in which the company might have a dual class share structure and then trade at a discount as a consequence. The company might be incorporated in a jurisdiction unlike Delaware that is an expanded constituency state and trades at a discount as a consequence of that. There may be a variety of ways in which you can improve the corporate governance. It might be a staggered board and you move to a de-staggered board. That's one where shareholders can sort of elect the board each year as opposed to a subset of directors each year. There are a variety of ways you can improve the corporate governance of a company. The fourth area in which it sounds kind of soft, we see this a lot, is investor communication. actually communicating to investors, communicating to market participants. This is what we do. This is how we do it. This is why we're a compelling investment opportunity. This is why you as an investor should entrust your capital to us. Those are kind of four different buckets in which to think about how we improve a company. And it's obviously highly situation specific, right? So it's not like we have, okay, we always do X, we always do Y, we always do Z. What I would say is it's rare for us, and I think we generally try to avoid situations that require a change in management to achieve the improvements that we seek. And the reason for that is pretty straightforward, which is I think there's a mistake that is made often outside looking in as to what people like me, activist investors, do. We're not in the fighting business. Our job is not to go out and get into fights with companies. That's not what we want to do. That's not what we like to do. And I'd prefer if we were never in the newspaper. I would prefer if we never had to run a proxy account. I would prefer if none of that ever existed. Right? Our job is to go out and make money. Our job is to go out and produce performance improvements that actually, produce compelling returns for our investors. And the easiest way to get into a fight with a company is to sit down and you sit across the table from the CEO and you say to the CEO, he or she, you say, Mr. CEO, the way we're going to improve this company is by changing the CEO. Usually the CEO doesn't like when you say that. So we try to avoid those situations. I should add a fifth, and I think this is an important one. It's a big part of what we do, and I should have classed it. We should change maybe the organizational structure of the company. Maybe the company is should be split apart. Maybe it should sell a division, sell some assets. Sometimes a company, maybe one thing, and we talk about this about smaller companies. Sometimes a lot of these smaller companies shouldn't be public companies in the first place. These companies, it's unlikely that they're ever going to be appropriately valued in public markets. That's fine. And so if that's the case, the company should consider, going private. So those are, I would say, the 5 different ways we can we tend to try to affect change in a company.
I like to double click on one of those items that you just mentioned, which I think was number 4, this idea of clearly articulating the strategy and the approach. And I think that kind of goes back to this notion of if you could be clear in your thinking and your understanding, clear in your writing, clear in your speaking about what the goal is. And usually that's at a higher level. I feel like so much of that is often missed because people are focused on the details. They're too zoomed in. And sometimes you have this experience of a fresh set of eyes comes in and sees something. I view that as they're properly zoomed out and they see what the vision is and they can clearly articulate. It's such an important aspect of all this.
I couldn't agree more. I think, look, it's funny we're doing this in a interview type or conversation type format. I mean, I personally prefer writing. I mean, I think our view is clear writing is evidence, maybe necessary but not sufficient evidence of clear thinking. We have a very written culture at our firm. We try to do a lot of things in the form of written communication, written memos, written letters to the companies in which we're invested in. So we're a very writing-oriented firm. I think just to go on to go through on your question, I think you'd be surprised, or I think most people, maybe you wouldn't be surprised, but most people would probably be surprised if you went to the CEO of a publicly traded company, and then you went to the board of directors and you said to each person, you hand them a piece of paper, and you said, can you write 1 page on how your company creates value for the owners of the company, the shareholders? I bet you a good number of them couldn't do it. What are the competitive advantages of your business? Or they couldn't do it without writing a bunch of kind of corporate jargon and all that, but couldn't, like in very clear, simple, basic prose, tell you, how do you make money? How do you create value for your owners?
Why do you think that is?
I think it's what you said, which is you get focused on, if you're a CEO, you think, okay, I'm hired by the board to do a job. And that's not, anybody who owns a business doesn't think of themselves as, if you're a business owner, you own a small business, you're an entrepreneur who's built a business, you don't think so, hey, my job is to run the company. No, your job, you own the business, your job is to create value at the enterprise. That's your job, right? And I think, but most CEOs say, okay, I'm hired by the board, to do a job. My job is to increase the revenue of the business. My job is to increase the EBITDA of the business, the earnings of the business, or my job mostly is not to get fired. So that means hitting my quarterly earnings estimates every quarter. Those are the kind of things that most CEOs think about day to day. I don't think they'll and it's understandable. The pressures that and by the way, this is not because these CEOs aren't smart. It's not because they're not capable. It's not because they're not thoughtful people. It's just the pressures of the job are immense, and the day-to-day demands of the job are immense. So I think one is maybe maybe if I break it down, I'll probably try and make this as clear as possible. One would be there's a psychological thing about how CEOs approach the job. They're doing a job as opposed to owning a company. One. Two, and this, by the way, is true of the board, members of the board too. I think a lot of board members view themselves as being, their job is to be a good director as opposed to be a good owner. Okay, so that's one. Two, I'd add the incentive structures for CEOs and for executive teams are often not necessarily aligned with the ways in which value can be created for shareholders. That's another way in which we can often improve companies by increasing the alignment around value creation for shareholders with the ways in which the executive team gets paid. So one, psychology, two, incentives, three, I would just say the day-to-day demands of the job, and there's a crisis. If you're running a business, there's usually a crisis every day, and then you've got on top of which you've got in public markets, you've got a quarterly cadence. You report earnings every quarter. You're worried about how people can react to that. How are analysts going to react to that? So I think those are probably three things: sort of psychology, incentives, and just natural sort of day-to-day demands are the reasons why.
What you're saying makes sense to me, in that if you can identify and clearly articulate and execute creating value for the owners, then that should benefit everybody. And you can mess that up in a lot of ways. So it sounds like a lot of what you're thinking and your perspective is you see the gaps in creating value for the owners, and you come in and try to execute that. And I guess a lot of it has to do with convincing everybody involved that this is the way it should be approached.
Yeah, I think that's exactly right. And look, some of these things, right? I mean, there's a larger conversation, but I think that we haven't quite figured out how to appropriately pay executive teams in public companies, right? I mean, I think if the way in which I think if you look at, there's a reasonably linear relationship, let's call it, high correlation between the size of a public company, okay, and the compensation of the CEO. It's not obvious that should be the case. Okay, and certainly that creates that in of itself generally creates a misalignment of incentives. Maybe a company should get smaller. Maybe it's really good. Maybe it's got 5 divisions, and it's great. And it's really well positioned in 2 of those divisions. It's got it's competitively advantaged in 2 of those divisions. It earns compelling returns on capital, can deploy incremental capital at high rates of return in those businesses. But the 3 other ones, it shouldn't. Maybe just sell those 3 businesses. It should exit those 3 businesses. But then the CEO is running a much smaller company. And then maybe the compensation of that CEO goes down. I mean, maybe the ways in which we compensate the CEOs generally, in terms of you got to go read the proxy, and it's like reading a proxy is like it's this Byzantine kind of thing to try and figure out. Okay, how is the CEO actually get paid? There's an annual incentive plan, an AIP, there's an LTIP, a long-term incentive plan, and then the long-term incentive plan is around these 4 different metrics modified by this TSR metric modified by these board qualitative assessments. It's a mess, and I don't think we've quite figured out how to create good alignment and proper alignment necessarily between public company executives and their shareholders in terms of creating long-term value. And that's an ongoing challenge. And look, that makes sense. I mean, basically, it's the broader principal agent problem that we consistently are trying to solve in sort of when you have a distributed shareholder base run by a concentrated management team.
And also, you have a stock price that people look at every second, and that drives more short-termism than it does long-term, perspectives of creating value.
Absolutely. By the way, I think the funny, that's one of the things that there's I love this, all on the defense side, and defense being that the advisors, the law firms, the bankers that advise companies when dissident shareholders like us or engaged shareholders like us get involved. They always talked about guys like me as we're the short-term ones. We're short-termist and all that. And I think it's always the most short-term person on the planet is sort of the CEO or is the management team. Okay, when there's an activist shareholder involved, they're focused on the stock price. They're hyper focused on stock price day to day. We're not actually, and I've been surprised, negatively surprised by how focused boards and management teams are on the day to day share price. I mean, we often just take a step back, or we constantly are telling companies just do the right thing. If you think something's going to create value, just do the right thing. It's a weird thing too, because I think management teams tend to have this markets will figure things out. They think that, if you can do something in the short run that makes the things look better in the short run, markets won't see through that. Markets tend to see through that kind of stuff, and vice versa. If you have to take some pain in the short run for long-term benefit, markets too can sort of look through that and price appropriately. So we're always telling companies just do the right thing.
It's so interesting. If I'm an observer of this conversation that doesn't know much about the markets, there's a lot of parts of it that seem quite counterintuitive. So you're an outside investor coming in, and you recognize that predicting the future is hard. So you want to hedge out the market risk. Whereas the people managing the company, they theoretically have more control over the outcome, but they're more focused on the things that they can't control. And they're driven by the things that they can't control. The market price that changes every second.
Yeah, it's also it's also a funny thing too, where they're driven by the market price that changes every second, which they can't control. And yet, in many cases, boards and management teams own very little stock. So the stock price is viewed as this like day-to-day scorecard in terms of how they're doing. So it's kind of bizarre.
I've heard you talk about having an owner's mindset, and you touched on that a little bit. Would you delve into that a little bit more?
I mean, it's just this. It's thinking about what are the actions in any given situation that are going to maximize the value of the enterprise for its owners, and that's how a company should be run. Our job, is to make NPV positive decisions at companies, and not worry about all the other kind of noise that's out there in markets and press and all that kind of stuff.
That's easier if you're running a private company, but it shouldn't be really different from a public company.
Yeah, I mean, I think I think the basic insight I think that the private equity firms have done is they've tried to collapse some of the principal agent problems that exist, right? By getting essentially closer, by collapsing ownership and control, the distinction between ownership and control, right? So, it's obviously not the PE partners that are running the companies that PE firms own, but generally it's the PE partners that sit on the boards of the companies they own. Whereas by contrast, in a public company, you've got a public shareholder base, the shareholders elect the board then picks the management team. And the misalignment sort of occurs, the sort of board picking the management team and the board members not necessarily being fully aligned with the shareholders. And so the PE guys try to collapse that distinction between ownership and control. But, in theory, there should be no difference between the way a CEO approaches running a business that's a public company versus running a business that's a private company. What's value maximizing in a private context is no different than what's value maximizing in a public context. I mean, the number of times you've had executives say to us, well, if I do this, the market's going to hate, it's the right thing for the company to do, but the market's going to hate it. And we're like, no, the market's fine. The market will be okay. Just explain it. Explain why it's great value, why it's a good decision, why it's thoughtful, why it makes sense, why it's an NPV positive decision. And the markets will understand it. That advice is often hard to, that doesn't necessarily come, it's not all that successful.
In your experience, how common is it to find public companies that are operating relatively inefficiently?
I think the universe of public companies that are operating inefficiently is vast. I think the question, or the massive, there's tons of them. I think that the tricky part for us is not necessarily finding companies that are operating inefficiently. It's finding situations that we're in where we can make a difference, right? And so, there's a variety of considerations. It's one, what is the type of change that needs to happen at this company? And are we well positioned to help that company affect that change? Two is, given the nature of the shareholder base, given the nature of who owns this company, remember, ultimately, any sort of, we're talking about equity activism, put aside credit for a minute, any change that we make is ultimately about the power to persuade, right? Because basically the nature of securities laws in this country, right? You generally file a 13D when you get to 5% of the ownership of common stock of a company. You're subject to short swing profit rules at 10%. You're generally owning, if you're a shareholder like us, or even a big firm like an Elliott or Bill Ackman or Carl Icahn, they're just operating bigger companies than we are. But we own 3 to 7, 8% of a company. We can't force anybody to do anything. So we have to persuade the management team, we have to persuade a board of directors, we have to persuade other shareholders that we are correct in sort of what we think this company should do to create value, right? So question one is sort of, what change does the company need? Or question two is, are we well positioned to sort of affect that change? 3, are we affect that change? Do we know something about the change that has to happen, and are we intelligent and thoughtful about that change? Question 3 would be, given the nature of the whole shareholder base, given the nature of the management team and board, are we well positioned to make that change happen, or to persuade the necessary folks of the merits of that change? And then 4th, and probably the most important question, And by the way, it's a question that we start everything with: is this putting aside all the things we want to do to this business? Is this a compelling investment? Are we buying a business that we actually want to own? Because I think one of the challenges when you're in my job, I don't want to say it's like when you've got to hammer everything looks like a nail kind of thing. But one of the challenges that I think, one of the ways in which activists or engaged shareholders tend to screw up, tend to mess up, right? Andy and I spent a lot of time thinking, how do we screw it? I mean, I think it started this about our partnership. How do we mess this up? How do we blow up? What are the ways in which we get it wrong? And one way that we've seen that activist investors like us get it wrong is just because something can be fixed doesn't mean you should spend your time trying to fix something. It doesn't mean, maybe it's a business that's in a broken industry. Maybe it's the number of, give you an example, the number of investors that over the years, and not to say that there's not money to be made here in some way, but certainly not for us, that over the years have tried to go in and take positions in department stores, for example. Okay, and go and try and fix department store chains, okay, or monetize the real estate of department store chains, or all these other different ways in which people have tried to make money in department stores. And it's just, and I don't know if any of those have actually worked. I mean, you might know better than I do, but it seems like that's just a really, really hard way to make money. And so what we've got to do before we even do all the stuff about the changes that are necessary, our ability to affect that change, our ability to persuade, all that, we just got to ask: is this a business that we actually want to own at a price that we want to own it? And only if we can answer that question in the affirmative do we even get to the other questions about our ability to produce change.
With as much detail as you're comfortable, could you provide any examples of how you've successfully improved companies in the past?
Yeah, I mean, we've been involved at everything from a biotechnology company where we've encouraged that company to monetize a number of assets at that company that were sort of under monetized, and we put an independent director in that boardroom and work with that company to actually get essentially two shareholder representatives at that company. And that company's in the process of cutting unnecessary costs, monetizing some assets, and returning capital to shareholders. I've recently sat on the board of an aerospace, kind of a subscale aerospace and industrial conglomerate that was overlooked in the public markets that's ultimately decided to sell itself to a private equity sponsor. We've been involved in a media business that owns a hodgepodge of assets, let's call it, really good, high quality assets, but a kind of an unwieldy collection of assets. And we've been encouraging that company to sell some of those assets, to split itself up in various ways. And it's in the process of undertaking a strategic review. We're involved in a healthcare services business where we're trying to reset the compensation structure for the executives in a way that better aligns the executives with the sort of value creation for shareholders.
That's great. Now, do you feel that being a smaller investor, obviously there are some advantages, but are there some challenges as well?
I think if you'd asked me that question a decade ago, I would say to you that the challenges, it'd be extremely difficult to do what we do, this engaged investing, style investing, without bringing a lot of resources internally into the firm and bringing in terms of lawyers and PR folks and bankers and advisors and all sorts of people around these engagements. Over the past decade plus, there's been the engaged investing, activist investing world. There's been like a real cottage industry that has developed. And there is now a robust network of law firms, advisors, bankers, academics who are operating in this universe, and we can tap into those folks on an as-needed basis. And so I think a lot of the disadvantages that existed as recently as, even sort of 7-10 years ago, are sort of have gone away.
What would you say are the biggest challenges and opportunities in activist investing over the next 5 to 10 years?
It's going to be really interesting. I mean, one ongoing question, right, is going to be how does the shift in assets from actively managed mutual funds to passive ETFs, how does that affect corporate governance in America? I think one of the most under-discussed things is there has been a quiet revolution where, right, if you look at a U.S. listed index included company today, okay, 5 out of the top 5 shareholders, certainly the top 10 shareholders, it's probably Vanguard, BlackRock, State Street, probably in that order, right? Okay, and that wasn't necessarily the case a decade ago, right? We've all seen these like charts where it's passive flows are up and to the right and active flows are sort of down and to the right? And that doesn't seem like there's any sign of that changing necessarily, right? So you're going to find yourself in a world where, corporate America is essentially owned by these big passive, these passive giants, and how are they going to wield that power? John Coates, who's a professor at Harvard Law School, has written an interesting book. I think it's called The Power of 12. I think it's The Power of 12. about how these organizations wield their power in the marketplace. So I think that's an ongoing question. I don't know if it's a pro, I don't know if it's a con, but I think it's just an ongoing question as to how we navigate a world that is increasingly dominated by those three institutions in particular, but certainly that's just broader flow into passive investment strategies. So that's sort of one. I think two is going back to this conversation about Dave Einhorn said, the universe of companies that are $2, $3, $4 billion companies. I mean, it's amazing to me. You've $2, $3, $4 billion companies. They're covered by 1, 2 sell-side analysts. Right, so it's also being the investment research. I know you know this, but the investment research shops that put out research, right? So they're covered by 1 or 2 sell-side analysts. These these companies, their shares, they don't trade all that much. They'll trade 50 basis points of the market cap every day, and so the coverage on the buy side is a consequence of the limited liquidity. Okay, that's also increasingly thin in terms of that coverage. I mean, there's a massive opportunity in these companies that probably shouldn't be public companies, probably have various ways that they could be improved even as public companies. They're just overlooked. So I think the universe of everybody's focus, right? Look, the S&P 500 was up. I mean, the S&P I think last year was up 25 or so with dividends reinvested. I think was the S&P 500. The S&P 500, I think equal weight, correct me if I'm wrong about this, was up maybe 14% equal weighted. Right, so not capitalization weighted, but equal weighted was, and then the S&P 600 small cap index I think was up 8.5%, 9%, if I'm not mistaken. So I mean, beneath the surface of the extraordinary performance of a handful or 2 handfuls or so of securities, there are I think a number of companies that are increasingly undervalued, increasingly underfollowed, increasingly ones that are attractive for us to make an investment, catalyze some positive change.
So, Adam, if you were to look back on your career so far, what would you say are the most valuable learning experiences or even the biggest mistakes that you've had?
The biggest mistake and the most valuable learning experience often go hand in hand, right? But when I was at Elliott, we were involved in the separation of what was then Alcoa Inc., the sort of broad integrated aluminum business, into 3 companies: Alcoa, Arconic, and Howmet Aerospace. And I think we initially we had a thesis about the operating performance of the business being improved, but probably needed a management change at the business. And it took us a number of took us multiple shots on goal, let's say, until we got the right CEO in place to do the management change. And that CEO, who now is running Howmet Aerospace today, was an extraordinary CEO, a remarkably talented guy named John Plant. If you look at the returns to Howmet, it's been exceptional. But it took us a number of times to get John, to get the right person in John into that seat. And so the lesson that I take away from that is that, one, initially we had to have a proxy contest with Alcoa, with Arconic, initially to sort of get the first initial management change. So one was that lesson of, hey, if you want management change, you're often going to end up in a fight. That's one. 2, picking CEOs is really hard, really, really, really hard. And so I try to avoid, even if we're successful in advocating for change in management, I try to avoid situations where we have to change management.
That makes sense. So Adam, the last question I'm going to ask you is, what is a contrarian view that you hold about markets or investing that you feel that most of your peers may disagree with?
I think markets are pretty darn efficient, which doesn't sound all that contrarian.
Well, today it's more contrarian.
Right, but meaning, obviously we've had this discussion about Einhorn and Cliff Asmus and all these people saying markets are less efficient than they used to be. And I think that's very possible, and I think that's increasingly true. But I think broadly, I mean, look, one to state the obvious, right? I don't believe, and the reason I say that was a bit of a flip answer in some sense of saying, hey, I think markets are efficient, but I think certainly, there are a lot of folks who spend a lot of time trying to figure out, who think that they can, that the analyst, he or she, can have a better view on, say, NVIDIA's earnings power in 5 years, or Microsoft's earnings power in 5 years, or Apple's earnings power in 10 years, or what the terminal value of Google is. I have no idea how anybody can be convinced that he or she has a better ability to predict the terminal value of those companies or the earnings power of those businesses in 5-10 years than the next person. I certainly don't think I can. I'm certainly not smart enough to do that. And so that's what I believe. And there's a lot of capital, a lot of investment, a lot of dollars managed by very, very, very smart people devoted to trying to figure that out. And I just don't think I have that. I have a hard time understanding how people believe that they can figure that out.
Well, you can be fooled into believing that by guessing right and then the market confirming that you're right and then attributing skill to that rather than luck.
Yeah, I think that's right.
Well, Adam, I really enjoyed that conversation and I hope our audience did as well. Thank you for joining me.
Great. Thanks, Alex. Really appreciate the time.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for